Hi guys, welcome to another video by Optionables. This is Saket and today we are going to learn about power of compounding. So in this video we are going to see how even small amounts can turn into a huge sum over time if you compound it. We would have already heard stories of Warren Buffett and Jhunjhunwala. So Rakesh Jhunjhunwala and Warren Buffett, they are one of the greatest investors of all time. So now these people didn't create wealth overnight. So it is over time they created wealth. So what made the difference to them is power of compounding, and that is what exactly we are going to understand in this video. Once Einstein said that the power of compounding is the eighth wonder of the world, and he who understands it earns it, and he who doesn't pays it. So most of you here will already know about power of compounding. So this is just a short video. We'll be trying to look at different aspects of compounding. So hope you like the video. Please do like, share and subscribe if you're liking the content on the channel. Hi guys, welcome to this video on power of compounding. Here we have assumed that we'll be growing our wealth at 2.5% every month. So if we grow 2.5% every month compounded rate, it is going to add up to 35% a year. And to just give you a relative idea of how much is 2.5%, if you have 1000 rupees in your account, you just have to earn 25 rupees a month. So that is what we are talking about. So if you have 10,000 rupees in your account, you will have to earn 250 rupees in a month. So that constitutes to 2.5%, and we are going to see how much difference can this 2.5% make over a longer run. So in this example, we are just considering 500 rupees. 500 rupees in your account growing at 2.5% every month, which is 35% a year. 1 year later, your 500 rupees is just around 675 rupees. So it is not looking quite big, right? So only around 175 rupees extra. So 5 years later, your wealth has suddenly become 4 times, that is 400%. So 35 into 4 is not actually adding up to 400%. So how did it happen? So here is where power of compounding kicks in. So 5 years later, you have already got 400% return, and it is already at 2000 rupees. Your 500 rupees is already at 2000 rupees. Now going to 10 years, it has grown to almost 10,000 rupees. So it is not double. So 5 years 2000, 10 years people usually expect it to be 4,000, right? But that is not the case. Here the money has almost grown 4 times more, which means now the amount is around 10,000 rupees. Only 500 rupees you are starting off with, and now you have around 10,000 rupees. And 15 years later, you have around 45,000 rupees. It is still looking small. So what will you do with 45,000 rupees? But it is relatively big. You have just started with 500 rupees, which means you have made a huge progress, but it's just around 45,000 rupees. Here is where it actually starts to matter, because you have almost spent 30 years. So how much can this make a difference? So you had around 45,000 rupees, and 30 years later, you have 40 lakh rupees. So how did it become so much? That is because of power of compounding. We are just talking about 500 rupees has already become 40 lakh after 30 years. So what do you think will be the value after 50 years? So believe it or not, the value is going to be 165 crores. So we are just talking about 500 rupees becoming into 165 crores in 50 years. So but here there's a catch. It is not easy to make it grow at 35%. It is a bit unrealistic assumption, but why I have assumed here is, if you are working with a smaller capital, trust me, you can achieve 2.5% a month. So only if you start increasing your capital and you go over, say, around 100 crores, 500 crores, it becomes harder and harder to achieve the same growth rate. Right now at Optionables, we are quite easily able to achieve 2.5-3% every month. So this is why it is so important to understand power of compounding and stop trying to double your money overnight. Stop trying to double your money in maybe course of 3 months or 6 months, because if you do consistently really well, you are going to get rewarded in a big way, and that is what you have to aim for. So give it time and you are going to have a huge reward. So don't try to hurry and reduce your reward. That's why it is very important to understand power of compounding. So this is what I meant. So Einstein told that compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. Okay, as I mentioned, you will be able to achieve around 2% every month using options. 2 to 2.5% should be achievable using options or any sort of equity trading in markets with lower capital. So we are going to see how much each percentage will make a difference. Say you're investing 2000 rupees for 30 years at various avenues. Let's say at a bank you get 4%, in some other place you get 5%, in some other place you get 15%. So how much will this make a difference is what we are going to see in this example. So I'm taking 2000 rupees here and I'm investing for 30 years. Keep in mind I'm investing for 30 years. So at 5%, the value is somewhere close to 8000 rupees. So which means over the course of 30 years, the wealth has only grown almost 4 times at 5%. So that's the reason people say don't put it in bank, invest the money in stocks, invest your money somewhere else. So this is the main reason, because if you keep it in your bank, imagine if you had kept it at 4 or 3, it's even lesser, so it wouldn't be even 4 times. Let's say instead of that you choose a little wiser option and you invest at 6%. So that will give you 5 times your money, almost 6 times. So you have invested 2000 and you're almost getting 12,000. So now let's say you make a even smarter choice and put your money at 9%. So if you put at 9%, it would have increased almost 13 times, that is 26,000 over the same course of time. And if you invest it at 10%, it would have become almost 17 times at 34,000. And if you put it at 15%, so 15% is again an ideal figure which you will be able to achieve by investing in mutual funds as well as equity. So if you just put in Nifty alone, that is more than enough to get a return of 15%. Nifty on average has already given 14% plus returns over course of time. You can see the difference in putting in bank and putting in Nifty. So let's say your bank is offering you 5% for your FD. So now the savings bank rate is just around 3%. So we don't even have to calculate how bad it is going to be. So let's say you put in FD at your bank at 5%. So 30 years later you will just have 8,000 rupees. But if you put that in equities, 30 years later you have 1,32,000 rupees. So we are just talking about 2,000 rupees here. Now 20%. So with 20% you have 4,74,000. So when equity itself is giving you say 15%, buy equities, pledge the shares and try to get another 5% through options. So that will give you 4,74,000 rupees. Only 2,000 rupees. It has almost already grown somewhere around 200 times compared to 4 times in your savings bank. Again, 30% might be unrealistic for a very big capital, but you can easily achieve with the lower capital. You can pledge your shares will give you around 12% return, and over that you can earn around 18% return from your options or futures, and that will give you 52 lakh rupees. So you can see that how each percentage is making such a huge impact on the overall returns. If it's 5% to 30%, it is not 6 times, but it is almost somewhere close to 500 times the difference in return. So this is why it is really important to understand why each percentage point matters and why keeping for long term matters. If I change this 30% in 30 years to say 30% in 10 years, the return is going to be really small. So people usually underestimate this pretty much. Each percentage point makes a huge difference. So you can see here from 5% to 10%, the returns are not double, but it is almost 4 times extra. So this is where it makes lot of difference by investing, whether it's 21% or 19% or 20%. So it is going to make a huge difference. Now we are going to come to the final part. Does the capital matter? So where you start actually matter. Can you actually do better than a person who has much more capital than you? Now we will take example of Amar, Akbar and Anthony. So let's say Amar puts it in his bank. So he has 10 lakh capital, quite a big capital, and he doesn't want to take any risk. So he puts it in the bank. So Akbar, he invests in gold at 8.5%. So Amar is getting 4% return, Akbar is getting 8.5% return. He has half the capital of Amar. He just has around 5 lakh. So can Akbar actually beat Amar over time? We are going to find out. Let's assume we have Anthony who is picking stocks and investing at 16% rate of return. So when he's investing at 16% rate of return, with the initial capital of 50,000, so you can see he has 10 times lesser than Akbar and also 20 times lesser than Amar. So he has such a small capital. So now over time, do you think Anthony will be able to overtake Amar and Akbar? We are going to find out that also. Before which, I want to tell you something else. So we spoke about achieving 20%. Warren Buffett has been able to do this consistently for more than 50 years, and people might ask why he is so rich. For the same reason, he has been able to grow his wealth at over 20% for more than 50 years. So this is something tremendous, and that's the reason today he is one of the richest person on the planet and considered to be the god of investing. Amar, after 5 years, is going to have around 12 lakh rupees, and 20 years later he is going to have around 20 lakh rupees, and 35 years later he is going to have around 38 lakh rupees. So he has basically grown his value by 4 times. 10 lakh has become 40 lakh, somewhere close to 40 lakh. So now Akbar, who is starting with half the capital, will he be actually able to overtake Amar? We are going to find out that. So you can see that Akbar 5 years later has 7.5 lakh rupees, and 20 years later he has already overtaken Amar with 25 lakh rupees, and you can see 35 years later he has almost twice as much as Amar with 86 lakh rupees. You can see that the difference in the amount is just 4.5%. The initial capital is half of the capital invested by Amar, but still Akbar has been able to do much better than Amar just because he invested at 4.5% higher rate. And over the years you can see the difference. So in first year, second year and 5 years you can't see big difference. So you can start noticing the difference only after 5 to 10 years. So that is when actual difference starts to rise. So now we'll go to Anthony. Anthony just has 50,000, which is 10 times lesser than Akbar and 20 times lesser than Amar. So can he overtake both of them? Yes, he surely can. So 5 years later, Anthony just has 1 lakh rupees. With 1 lakh rupees, he is still 10 times lower than Amar and 5 times lower than Akbar. 20 years later, he just has 9 lakh rupees, which is still lower than Amar and still lower than Akbar. But 35 years later, he would have had 90 lakh rupees, which is much more than Amar and much more than Akbar. So it is almost somewhere close to 2.5-3 times of Amar, in spite of starting 10 times lesser. So this is why understanding power of compounding makes a huge difference in your investing as well as trading journey. I hope you liked today's video. If yes, please do hit the like button, subscribe and share this video with your friends. Thank you so much for joining.